Good morning, at least it's morning in Las Vegas here. I know we have a few individuals from East Coast joining in as well. So good afternoon to the people on the East Coast. And it's a pleasure. This is Mahesh Odhrani with Strategic Wealth Design, and welcome to our first presentation for the Financial Wellness Series regarding our topic today is regarding the CARES Act and understanding the CARES Act. So just a few housekeeping items. Everyone is muted on this call. This call is being recorded as well, and the recording will be available in a few weeks once it goes through compliance approval. And if you have any questions during the meeting, there is a chat box as well as a question box where you can put in some questions or feel free to put it in the chat box, and I will be happy to field those questions after the presentation is done. So if there's anything that I say in this presentation that you have questions about, feel free to put it in the question box or the chat box. And on your screen, you'll probably see my video up on top and the presentation on the bottom, and there's a little toggle switch. If you want to make it full screen, you just move that switch up right between the video and the presentation, and it will turn off my video, but it'll give you full screen through the presentation as well. So feel free to do that too. So let's go ahead and get started. I know this presentation is for about the time block that we let you know about was about an hour. I don't think we're going to take up the full hour, just depending upon what questions come through. So we will. This presentation is probably about 20 minutes, maybe 30 minutes at most, and depending upon questions, we'll spend a few more minutes on questions after that, so you guys can get on with your day. The next 3 financial wellness seminars that we have for the next 3 Thursdays on cash flow management, investing in retirement accounts, and retirement income planning, we will be taking up the full hour for those meetings. So today's topic is understanding the CARES Act and the important provisions for plan participants investing in retirement accounts, either in 401k plans with their employer or in individual retirement accounts. The CARES Act had a lot of provisions. We're not going to talk about everything that CARES Act covered. We're not going to talk about unemployment benefits or other tax benefits that came out from the CARES Act or the tax provisions that came out from the CARES Act. We will specifically focus on 2 retirement topics, and I'll cover those here in a second. Just a quick disclosure that this material is educational in nature. We're not trying to provide investment advice for any specific individual or situation or act in a fiduciary capacity. Please contact us if you would like some individual guidance for your situation, and because there's some tax related situations in here as well, depending upon the topics that we'll discuss, please consult with your tax accountants for those questions. So let's talk about what is CARES Act. Everyone's heard about it. The official title of it is Coronavirus Aid, Relief, and Economic Security Act. What we're going to talk about, as I mentioned, there's a lot that was covered in the CARES Act. We're going to focus on these 2 topics, retirement account distributions and required minimum distributions. So we'll cover these 2 topics through this presentation. So to be eligible for what they call as coronavirus-related distributions, IRS has set up these guidelines to qualify for those type of distributions. The guidelines the eligibility requirements are diagnosed for COVID-19 by a CDC-approved test. You have a spouse or a dependent that has been diagnosed, or that you've had adverse financial consequences due to COVID-19, either being quarantined, being furloughed or laid off, work hours reduced, closure or reduction of hours for a business you own or operate. So if you're in a business that was impacted because of stay-at-home orders, can be covered under this as well. Unable to work due to childcare, or as determined by the IRS. And IRS over time has clarified some of these rules and the impacts, and I have no doubt that with additional stimulus package that they've been talking about in Congress, there may be more provisions that may come around regarding these distribution rules as well. So if you're eligible based upon these guidelines, then you can request certain types of distributions from your retirement accounts, and we'll talk about the penalties and tax consequences as well. Now, this certification is a self-certification. So generally, in certain types of distributions, IRS, or if you're processing it, a distribution from your employer's retirement plan, like a 401k plan, there's proof that is required for some certain types of distributions. However, this specific eligibility requirement is a self-certification that IRS has mandated, and this is something that I believe you will be also certifying up on your tax return if you were impacted by COVID-19 and you process any type of distributions that we'll discuss here in the next few slides. So CRD, coronavirus-related distribution. So individuals are allowed to take certain types of distributions up to $100,000 per individual in 2020. So if you have been impacted by COVID-19 and you're eligible based upon the guidelines we discussed in the previous slide, you can pull out up to $100,000 per individual in 2020. And this is aggregated between 401k and IRA accounts. If you're below the age of 59 and a half, you can avoid the 10% penalty, or the penalty is waived. So for any type of retirement accounts, individual retirement accounts, pre-tax accounts, or 401k accounts, any distributions that are processed are generally subject to a 10% penalty for individuals that are under the age of 59 and a half. So that penalty is waived this year. It is also required, traditionally it is required to withhold 20% for taxes when you process those distributions. So from the investment company, they will generally withhold 20% for taxes when you're processing those distributions. However, with the coronavirus-related distribution, CRD, is exempt from that 20% tax withholding as well. So when you pull out, let's say, $100,000 from your retirement accounts, you can essentially pull out the full $100,000 and not have to pay that tax withholding when you take that distribution. Well, as far as the taxes are concerned, the taxes are still due. However, you can spread that tax consequence over 3 years. So over 2020, 2021, and 2022. So when you do file your tax returns for 2020, you will essentially take 1/3 of that distribution as taxable income for 2020, and you can spread that tax consequence up over the 3 years. The CRD rules also allow for recontribution of the money that you took out within 3 years. So you do have 3 years to put that money back into the retirement into the retirement plan, into the IRA or the employer sponsored 401k plan. You have the ability to put that money back and recapture all those taxes that you would have paid in 2020, 2021, 2022. So for example, if you pull out $100,000 this year, you'll pay taxes on 1/3 of that distribution in 2020. You'll pay the next 1/3 in 2021, and let's say in 2022 tax year, within the 3 years, you fund all the $100,000 back into your retirement accounts. Well, you can recapture all those taxes that you paid in 2020 and 2021. Do discuss this with your accountants on how this process works. From what I understand is that this requires an amendment. So if you were to take advantage of this, this will require an amendment on your previous year's tax returns. So it will create additional costs and fees from your accountant standpoint to amend those tax returns and refile them in order to recapture some of those taxes for the previous years. Now, IRS may change those rules. They may come up with a simple form that you can just file in 2022. I don't believe that guidance has come out yet. From what it stands right now, the tax returns, I believe, have to be amended. So it may create an additional cost down the road as well. So this is available for IRAs and also 401k plans. If 401k plans allow for hardship distribution. So if you are in a 401k plan, and I know there's a few individuals on this call for 401k plans that we manage for your company. If the plan allows for a hardship distribution, and you may be eligible to take out this coronavirus-related distribution for this year and avoid the 10% penalty. But do remember, it's a self-certification that you have to be impacted by COVID-19. This CRD is only available for 2020, so before December 31st. So if you have been impacted by COVID, you have to process this distribution prior to December 31st. I know there's a few more people have joined in on the call. If you have any questions regarding what we're discussing, feel free to put it in the question or the chat box. All right, the next topic we'll talk about is the coronavirus-related loans. So if your employer allows a 401k loan from your plan, then and if they allow for a coronavirus-related loan, or if they allowed for it, this provision is expired as of 2 days ago. So new loans, you could have borrowed before September 22nd, 100% of your balance up to $100,000. And we'll talk a little bit about the loans and the impact of that overall. It applies to loans between March 27th and September 22nd. So if you took out loans, you could have pulled out as much as $100,000 in coronavirus-related loans. This does not apply to individual retirement accounts, IRAs. This also has to be available, and the provisions have to be available inside of your employer 401k plan. I know there are several participants on this call for the that are employed by companies for which we actually manage the 401k plan for. So if you have any specific questions, please shoot us an email, give us a phone call, and we'll be able to look up your plan, your specific plan, and see if this provision is available or not. But the loans, unfortunately, at this point, you cannot process a loan up to the max 100%, up to max $100,000 and 100% of your vested balance. You can still process a loan if your plan allows for it with the traditional guidelines, which is 50% of your vested balance up to $50,000. Now, again, with additional stimulus bills that are being discussed in Congress, that may change as well. So we'll see how that comes along. However, if you have current outstanding loans and you qualify for that eligibility that you've been impacted by COVID-19, that must meet the eligibility criteria, your loan repayments can be suspended till December 31st. You can still qualify for this today, even if you take out a loan out of your 401k or a 403b plan. You can defer those loan repayments till December 31st. The repayments will have to reconvene by January 1st, 2021. The payments will be adjusted for any accrued interest at that time, but you do have the ability to, if you're having impact to your cash flow, you do have the ability to defer these loan repayments till January 1st, 2021. And even if you take out a new loan today, you can defer those payments till January 1st, 2021. Talking about loans and taking loans from employer 401k or 403b plans, excuse me, funds that are taken out as loan are no longer invested. So especially in markets where volatility is high, it could be a benefit when the funds are out of the market if the market drops. But if the market does go up, the funds are no longer invested. So you do lose out on any market returns that may impact your account balance. So that's a big consideration when you're taking out loans. If you leave your job or are laid off, that loan has to be repaid or will be considered as a taxable distribution. So if your employer is going through layoffs that you're aware of, or if you don't have enough security in the job that you're in, or you're planning on leaving and looking for another opportunity, if you were to process a loan, that loan has to be repaid. Otherwise, it'll be considered as a taxable distribution. So that's also to keep in consideration that before you take out a loan, the impact if you were to lose your job or you end up leaving, that loan has to be repaid back, or it can increase your taxable income for 2020. So once payments convene and once the payments start up again on January 1st, 2021, you have to be prepared for additional pressure that may put on your cash flow at that time. Now, our financial wellness seminar for next week is going to talk about cash flow and debt management. So that would be good if you are having some pressures on your cash flow. If you have been impacted by COVID, that would be a good seminar, a good webinar to attend, because it will give you a lot of great ideas on how to manage your cash flow and also look at debt repayment strategies as well. Next, we're going to talk about the required minimum distributions. So required minimum distributions are when individuals turn 72, they're required to pull distributions out of their retirement plans, so 401k plans or IRAs. So that age was 70 and a half. Most individuals remember the age 70 and a half, but that was changed by the Secure Act that was passed about 18 months ago now, and that was changed to age 72 is now the age for RMDs. Now, if you are 72 years old or you're subject to RMDs, either because of being 72 years old or because of inherited IRA accounts, RMDs are suspended from retirement plans and IRAs for 2020. Now, this date has passed as well. If you did have RMDs that you took out prior to August 31st, you could have rolled those RMDs back into the IRAs, into your IRA accounts or 401k accounts. So if you did have any RMDs, you could have rolled those RMDs back in, and it would have that rollover back into the accounts would not be taxable. So that window is closed. Again, that was August 31st was the date for that, and that could be done for inherited IRAs as well. However, if you have any RMDs that are still, either you have not taken out RMDs for 2020, or if you have monthly RMDs coming out for 2020 and you still have, we're almost the end of September, but let's say for the next 3 months, for October, November, and December, you can suspend those RMDs from your IRAs and retirement plans, or skip those RMDs for 2020, so you don't have to take them as taxable income. And again, for a lot of individuals, if they're depending on those RMDs for monthly cash flow reasons, it may be beneficial to continue those. Again, it just depends upon an individual situation, so feel free to give us a call if you want to have a discussion about the RMDs and any strategies for the next 3 months. And that's pretty much what we wanted to cover today regarding the CARES Act and talking about the required minimum distributions and coronavirus-related distributions, either via loans, through employee retirement plans, or through IRAs if you've been impacted by COVID. So I'm going to open up the forum for any questions. Let's see here. I don't see any questions yet. So if you have any questions, just to let you know, go ahead and put it in the chat box. In either the chat box, or there's a question box as well, and I'll be happy to answer any questions. I know several individuals have joined as well. I'm not sure if you heard me in the beginning. I said this presentation is most likely going to be very short, 20 to 30 minutes at most, depending upon how many questions we get. And our next week's session is going to go over cash flow and debt management. And if you haven't registered and you are interested in that topic, please do register. If you are registered for that topic, we do have a workbook that will be sent out the day before as well, that you can use to follow along in the presentation as well. So that will be sent out next week. I'm going to wait another 10, 15 seconds to see any questions pop in here. So there was a question, define what an RMD is, and to clarify what an RMD is. So RMD stands for required minimum distribution. When you're investing in a retirement, when you have retirement accounts, IRAs, individual retirement accounts, or 401k accounts or 403b accounts, if once you turn age 72, you are required to start taking out distributions from those retirement accounts, because IRS wants you to pull out, take out some minimum distributions so that you can take it as income, and IRS can collect their income taxes on that distribution. So the distribution amounts, there's a formula, and it's based upon what they call is life expectancy. So IRS has a formula. It's basically around 72. Most individuals are probably going to withdraw about 3 to 4% of their account balance as distribution. You have to take it out. If you do not take it out, or you miss that deadline to take out the RMDs, then there's significant penalties and taxes that IRS imposes on the amount that you should have taken out. So RMDs are absolutely critical once you turn age 72 to start pulling out of your retirement accounts. Because there's some hefty penalties and taxes if you do not take out the required minimum distributions. So thank you for that question. A question was posed, what about the coronavirus stimulus checks from earlier this year from the federal government? Would that be considered a loan that needs to be paid back when we do our taxes? So thank you for that question. As I mentioned previously, we were just covering two topics, and the stimulus checks from earlier this year from the federal government, that's a more tax question, and what I would suggest is ask your tax accountant what the impact of the stimulus checks will be, and what the impact of the stimulus checks will be to your income. And I don't believe they're considered a loan, but they still may be taxable for income purposes. So what I would suggest is definitely speak with your accountant on the impact of that. All right, I don't see any other questions here, so we'll go ahead and end this call. Again, the recording will be available in a couple of weeks. What I would suggest is take a look at the invitation for next week for our cash flow and debt management webinar. It's going to be packed with a lot of great information. There will be a workbook as well that will be emailed to everyone that registered. So if you haven't registered, please do register for that. And we'll speak with everyone again next week, next Thursday at 11 a.m. Pacific time. Well, thank you everyone for being on the call, and have a great day.